Good evening, students. Welcome to this class. So today, as you know that we are going to start with the assessment procedure chapter. I see certain queries already being posted, Namita. Let me take up the queries for you. Construction of building. That is not exactly a kind of a contract, right? Because there is going to be the construction of building is the sale of immovable property. After building construction, we already have the TDS under 194I for the 195 for the sale of the immovable property. So construction of building contract is the builder is not going to work for somebody. He is going to do it. The building is going to be constructed on his own. So if you remember, for the joint development agreement, we had IC. For the sale of immovable property, also we have IA. So construction of building, it is going to be for its own. It's not going to be a contract. If it is joint development agreement, we already have EDS in the separate section, so not under 194C. Clear, Namita? In AOP, foreign company provision by word any member is used, only foreign company need to cover. I didn't get your question, Namita, regarding this. Is it that you are asking the higher rate for any member? So higher rate than MMR, it could be a foreign company, right? And if a foreign company is a AOP member, then it could be at a higher rate than MMR because foreign companies are taxed at 40%. Yes, Namita, on underwriting commission, there could be TDS. Again, I didn't understand what you're trying to say about surgery for patients in hospital where patients have sale of rupees 2 crores. I didn't get your question, Namita, regarding that. If you can just elaborate your question. Then the next question is, if A invested in Reliance, its shares to mutual fund units. So on dividend, Reliance will deduct TDS, while mutual fund will also deduct TDS. Namita, mutual fund is separate, shares are separate. If you understand both things, mutual fund have the underlying investments in shares. So when the Reliance would be paying to any dividend to the mutual funds, it will deduct TDS, and mutual fund will not directly pay the dividend based on this payment of the Reliance. So mutual fund will be issuing its own dividend on the units. So both are going to be very separate, if you understand. Is that clear, Namita? Any other question? Okay. So let's start with today's topic, which is assessment procedures. Now, under assessment procedure, what we are exactly going to cover? In assessment procedure, we are going to talk about the first part, which is return of income. Then we are going to see the assessment under section 143.1, 143.3, 147, assessment in search cases. All of that we are going to talk about in today's in today and tomorrow's class, or the next class which we have it on assessment procedure. So let's quickly start with it. First is we are going to talk about the return of income. So see, whenever you are giving the exam, right, you first write your exam and then the examiner will assess your paper and he will be giving you the marks, correct? And if you have any discrepancy with the marks, you can ask for the reopening of your paper, right? Or verification of your paper or inspection of your paper, right? Similar way, the assessee also files his return of income. Under Income Tax Act also, the first step is that the assessee is going to file his return of income. Why return of income is necessary? So assessee has to submit all his details regarding how much income he has earned during the year. If he has earned certain income, he will disclose that as his income. If his turnover is crossing a certain threshold, he is required to get his books of accounts audited also. What is audit? Audit is nothing but that the CA has to verify that whatever income is disclosed by the assessee is true according to the auditor. Right? So then, after that, the return of income is filed. The CBDT will come to know about the information which assessee is disclosing, is declaring under the return, the deductions claimed by the assessee, the losses claimed by the assessee, and based on that, the department now will start the verification that whether the income which is disclosed by the assessee is correct or not, whether the deductions which he has claimed are correct or not, whether the assessee is trying to hide certain income, whether the assessee is paying the lesser taxes than what it should have paid. So department will start verification, and that verification is nothing but the assessment, right? So once you make your return of income, the department's process will start. Then the department will call for additional reports from you if they feel that they want to check additional details from your books of accounts, because return of income is just kind of a summary of all your income. Now, if the department wants to verify, they will call for additional documents and information from you. And based on all the information provided by you, the department will complete the assessment. The department will complete the assessment. And that's what we are going to discuss in the second part. If you are not satisfied with the assessment order, what you will do is you will make an appeal. So that is the third part, what we will be discussing in the coming classes. Is that clear? So the first part is the return of income. Now under return of income, we have the return to be filed under 139(1). We have return to be filed under 139(1), which is the original return. Now return can be filed late also. It is possible that the return is filed late. That is a belated return. If you have made any mistake, you may revise your return. That's a revised return. Now, who is required to file the return of income? So 139(1) says that every company and the partnership firm and LLPs are mandatorily required to file the return of income. Right? Company, partnership firms, LLPs are mandatorily required to file the return of income. So even if you might not be having any income during the year in a company, quite possible that the company does not have any income or the firm doesn't have any income during the year, it is still required to file the return. Then the second category is if a person at any time during the previous year holds as a beneficial owner, if a person is a beneficial owner of any foreign asset, if a person is a beneficial owner of a foreign asset means any asset which is located outside India. Now that asset could be even a bank account outside India, or any interest in the entity outside India. Asset could be anything. It could be even a bank account. It could be the holding in any entity outside India, entity incorporated outside India. So if a person is a beneficial owner of any asset outside India or is a beneficiary of any asset, so either he is a beneficial owner or he is a beneficiary of any asset outside India. What do we mean by the term beneficial owner? Beneficial owner is defined as a person who has provided the consideration for the asset, the person who has invested into the asset, whether for himself or for any other person. So it is not necessary that he is invested only for himself, for the benefit of himself, but it could be even for the benefit of any other person. So the person in an asset is bank account or even any interest in any entity. Interest in entity meaning any holding in any entity, holding in any trust, holding in any partnership firm outside India, holding in any company outside India. What do we mean by the beneficiary? Beneficiary is the one who is deriving the benefit from the asset without contributing towards that asset. So it is quite possible that, say for example, Mr. A would have contributed to a trust. Mr. A would have started a trust in UK for the benefit of his son. Now, son is the beneficiary and Mr. A is the beneficial owner. So, any beneficiary or the beneficial owner have to file the return of income if they have any asset outside India. If the income is included in the income of the beneficial owner, then the beneficiary need not file the return. So either of them is required to file the return of income, either the beneficial owner or the beneficiary. Clear? Third category which is mandatorily required to file the return of income is individual, HUF, AOP, BOI, artificial juridical person, where the total income without giving effect to, without considering the exemptions under 54 series of capital gains or chapter 6A deduction exceeds the basic exemption limit. So the total income means what? Total income is generally defined as after giving effect to all the provisions of the Act. So total income is nothing but is your net total income after considering all of your deductions, exemptions, everything. But what does 139 says? 139 says that the total income should be the gross total income without considering the chapter 6A deductions and even the exemptions granted under 54 series. So if you have capital gain in your total income, say for example, if your capital gain is 1 lakh, which is exempt, say under section 54, and say your other income is 2 lakhs. Say your other income is 2 lakhs. Now, you also have deduction of say LIC of rupees 50,000. So you say that your 1,50,000 is your income, which is less than the basic exemption limit, and therefore you're not required to file the return of income. But what does 139(1) says? That your total income, which is 2 lakh, without considering the chapter 6A deduction, plus capital gain without giving effect to 54 series, which is another 1 lakh. So your total income is 3 lakh, and since it exceeds basic exemption limit of 2.5 lakh, you are required to file the return of income. So if your total income without giving effect to 54 series exemption or chapter 6A exceeds the basic exemption limit, you are required to file the return of income. Is that clear? So that is the third category. And any other person other than these category, if their total income exceeds the basic exemption limit, then they are required to file the return of income. Any other person other than what we have mentioned so far, so other than a company or a firm, other than a person who has a beneficial interest outside India, individual or HUF or AOP, BOI, other than that, if they're, so say for example, cooperative society, they would be required to file the return of income only if the total income exceeds the basic exemption limit. Then next category is for any person other than a company or a firm, even if the total income is not exceeding the basic exemption limit, they would be required to file the return of income if they have deposited the aggregate amount exceeding rupees 1 crore in current account maintained with either a bank or a cooperative bank. So if you have deposited over rupees 1 crore in bank, you are mandatorily required to file the return of income, even if your income is below the basic exemption limit. Or if they have incurred an expenditure of rupees 2 lakhs on the travel to the foreign country, either for themselves or for any other person. So say for example, if my father would have incurred rupees 2.5 lakh for my travel to foreign country, he would be mandatorily required to file the return of income even if his income is less than the basic exemption limit. Or the amount exceeding rupees 1 lakh towards the electricity bill. In that case, the person is mandatorily required to file the return of income. Is that clear? So these are the persons who are mandatorily required to file the return of income. Correct? Now, what are the due dates? By what due dates they are required to file the return? So the due date under 139.1 explanation to 139.1 is defined, wherein it says that where the assessee is a company or any person whose accounts are required to be audited under section 44AB or under any other law. So it is possible that there are certain firms like LLPs are required to carry out their audits under the LLP Act, right? It is possible that there are other kind of assessees who are required to get their accounts audited in any other law. For example, cooperative societies are required to get their accounts audited. Trusts are required to get their accounts audited. So person whose accounts are required to be audited not under say 44AB but even under any other law, or a partner of a firm whose books of accounts are required to be audited, then it is 31st October of the AY. Then the due date is 31st October. This year, all the due dates have been extended, but it is generally 31st October of the AY. In case there is transfer pricing applicable to the assessee, in case the assessee is required to submit the transfer pricing report, then the assessee as well as his partner will be required to furnish the report by 30th November. So if there is transfer pricing applicable, then by 30th November. If there is company or if the audit is required to be carried out, so that particular entity and its partners by 31st October. And any other assessee will be required to file by 31st July. Clear? What are the consequences? Very quickly tell me if I do not file my return of income by the due date. So we had discussed that while we were dealing with the TDS chapter, if you remember. There is going to be interest under section 234A at the rate of 1% per month or part of the month. Right? We have discussed that. So TDS is going to be applicable, 234A interest is going to be applicable. Right? We have discussed that, isn't it? And it is 1% per month or the part of the month. And it is on the amount, the interest is on the amount of the tax which is payable. The interest is on the amount of tax which is payable. So tax is what? The final tax payable after considering advance tax, TDS, MAT relief, FTC relief, right? If all the self-assessment tax is also paid, before filing the return of income, then no interest in the 234A will be charged. And it will be chargeable from the due date till the date of furnishing the return. And where no return has been furnished, then till the date of completion of the assessment. Right? We have done that. What is the other consequence of not furnishing the return within time? Fees under section 234F. So if a person fails to furnish the return within the due date, the fees is 5,000 rupees if the total income is above rupees 5 lakhs. If the total income is less than rupees 5 lakh, then the fees will be 1,000. So there is interest under section 234A, there is 234F, which is a fee for default in furnishing the return of income. Is it clear? Is it clear? So if you do not furnish your return of income within time, you have 234A as well as 234F. Right? These are the consequences. What are other consequences for not filing the return of income within time? What are the other consequences? The other consequences are there are certain deductions which are based on filing the return of income on time. There are other consequences of filing the return of income within time. Do not file the return of income within time. So deductions, certain deductions are based on return of income filed under section 139(1). If you have not filed the return of income within 139(1), then in that case, it is quite possible that those deductions will get disallowed. Right? Further, carry forward of losses is not permitted. Carry forward of losses is not permitted. So it is possible that you have certain carry forward of losses. Then that will also not be permitted if you have not filed the return of income within the time. Right? So these are the consequences if you do not file your return of income within the time specified, within the due date specified under section 139(1). Is that clear? Any doubt till now? Any question? Namita, I didn't get your question. If son ROI is also filed as he's minor child artist, will income from Mr. A Trust in UK included in son ROI or Mr. A ROI? I didn't get your question, Namita. If you can elaborate that question. What do you mean by, because whose trust you are talking about? Okay. Okay, let's proceed further. Let's proceed further. So as I said that if you are not filing your return of income, then it is going to be the interest under 234A. There is going to be fee under section 234F. There is going to be disallowance of losses. There is going to be disallowance of certain deductions, because certain deductions are to be claimed only if the return of income is filed within the time. Correct? Is that clear? Okay. Now let's proceed further. So now if you have not filed the return of income, say within the time limit. You have not filed your return of income, say within the time limit, then you have to file a belated return. You have to file a belated return, right? Now, belated return, by when it can be filed? Belated return, by when it can be filed? So, belated return can be furnished before the 3 months prior to the end of the relevant assessment year. So, your assessment year is going to end in, say, March. So, 3 months prior to that, which is going to be December. So, by 31st December, you need to file your belated return. Or even if you want to revise your return of income, then you can revise it also before the end of the 3 months from the end of the relevant assessment year or completion of assessment, whichever is earlier. Is that clear? So if the assessment has got over earlier, so then before the assessment is finished, you have to file your return of income. Clear? Now, certain assessees are exempted from filing the return of income. Certain assessees are exempted from filing the return of income. Who are they? So, central government has exempted certain non-residents and the foreign companies which are having income from any investment fund set up in IFSC, which are having income from the investment fund in IFSC, and the TDS is deducted under 194 LBB on those investment funds. So remember, we had done about AIF. We have talked about AIF while we were dealing with assessment of various entity. So if there is income from the investment fund, if these assessees have any income, non-resident or the foreign company have any investment from the AIF set up in IFSC, then exemption would be available to these person if the TDS has been deducted as per the rates in force under 194 LBB and they have only this income. However, exemption would not be available where a notice is issued under section 142 or 153A or 153C or 148 before the filing of return of income. Right? In that case, the exemption will not be available. If there is any assessment going on against them before the filing of return of income, then there will not be any exemption. The other assessees are non-resident or a foreign company who have only income from the investment fund, who have the income only from this investment fund. They are also not required to file their return of income. So, non-resident or foreign company who are having income from the AIFs will not be required to file their return of income. Non-resident who are having capital gains, which is exempt under section 47(6)(ab) from bonds, global depository receipts, rupee denominated bonds, derivatives, which are listed on recognized stock exchange in IFSC. So if the non-resident has the investment in bonds, GDRs, rupee denominated bonds, which are listed on IFSC, and if they earn only the capital gain income, which is also exempt under section 47, then they are not required to file the return of income. They are not required to file the return of income. Clear? So these are certain exempt category. Then it is also possible that it could be a loss return. It is also possible that it could be a loss return also. It is possible that you have a loss return. Now, what is meaning by the meaning of the loss return? That you have claimed certain losses, right? So if you have claimed certain losses, then you have to file return of income under 139(1) only. So you could have business loss, speculation loss, loss from the specified business, loss under the head capital gains, loss from activity of owning and maintaining resources. All these losses, if you want to carry forward, you have to mandatorily file within the due date under 139(1). If it is loss from income from house property or if it is unabsorbed depreciation, these can be carried forward even though the return is not filed before the due date. These can be carried forward even if the return is not filed within the due date. Is that clear? Any doubt till now? Gopinath, NR includes everybody, right? Okay. So that is about the return of income of loss return of income, right? Now, if if there are certain charitable trusts and institutions. So you would have learned about the income of the charitable trust, right? Now these charitable trusts have to furnish the return of income if their total income without considering the exemption under section 11 or section 12 exceeds the basic exemption limit, then they are required to furnish the return of income. And the return have to be filed by the representative assessee. Returns have to be filed by the representative assessee, who could be the trustee of the trust. And the due date will be 31st October, since as I told you, the trusts are required to carry out the audit under the Trust Act. So therefore, for them, the due date will be 31st October. Similarly, in case of the political parties, they also get exemption under section 13A. So without considering the exemption, if their income of the political party is greater than the basic exemption limit, then in that case, the political party is required to file the return of income. Then the chief executive officer of the political party is required to file the return of income. Also, for the grant of exemption under section 13A, it is very much mandatory that the political party is furnishing the return of income within the time limit or within the due date of 139(1), and it's submitting even the audited books of accounts. Similarly, there are certain research associations, there are certain funds or institutions, there are trusts like securitization trust we had learned, or certain debt funds which are there, right? They are also required to file the return of income if before claiming the exemption under section 10, their total income is exceeding the basic exemption limit. Similarly, universities and colleges are also required to furnish the return of income. Business trust is mandatorily required to furnish the return of income. AIFs are mandatorily required to furnish the return of income. So all these are certain mandatory categories of furnishing the return of income. Is that clear? Now there is a possibility that the return could be a defective return. It is possible that the return could be a defective return. What do we mean by the defective return? So quite possible that the return of income, when it can be said to be defective, when the return of income, certain columns in the return of income which are there relating to the computation have not been filled in correctly, or it is possible that the audit report is not submitted, or any proof of taxes is not submitted, or the assessee, say for example, he has not filled up where he is maintaining the books of accounts, but he has not filled up the manufacturing, trading or P&L account, right? Where the audit report is not furnished under 3CB, 3CD. Then in that case, it could be that the return is defective. And if the return is defective, then in that case, the AO has the power to call the assessee to rectify the defective return. So if the AO considers that the return of income is defective, the assessee has not duly filled in the balance sheet or not duly filled in the annexures or the columns in the P&L, then he may intimate the defect to the assessee and give him an opportunity to rectify the defect within a period of 15 days from the intimation. So if you see, you get the intimation of defective return for certain of your clients, right? If the defect is not rectified within 15 days, then the return will be treated as an invalid return. And it will be deemed that the assessee has not filed the return of income only. So if the assessee fails to rectify the defect within the 15 days time, then it will be deemed that the return has not been furnished only. If the assessee files after the 15 days, if assessee rectifies after the 15 days, then the AO can condone the delay and treat the return as the valid return. EO can condone the delay and treat the return as the valid return. Is that clear? Also, section 292B provides that the return of income shall be not deemed to be invalid merely because if there is any defect, mistake or omission in the return of income, and if in substance the income declared is in conformity according to the intention of the Act. So 292B carves on the responsibility on the assessing officer to not treat the return of income as invalid merely because of some small lapses if the return of income or the particulars of the return of income are in substance conforming to the intention or the purpose of the Income Tax Act. So just because of few arithmetical errors or small mistakes or small typographical error which are not materially affecting the return of income submitted by the assessee, it should not be treated as the defective return. Is that clear? It should not be treated as a defective return. Any doubts till now? Any questions or any doubts so far? Okay. Now, few case laws which I would want to discuss with you from this particular chapter itself, which are relating to return of income only. So there was one case of Supreme Court in the case of Dalmia Power Limited. The question before the Supreme Court was that they can delay in submitting the revised return of the amalgamated company after receiving the approval from the NCLT. After receiving the approval from the NCLT, but which was beyond the belated returns time limit also, can CBDT condone that delay? So the assessee had amalgamated with the other companies under the scheme of the amalgamation, after which the assessees filed the return after the prescribed time limit. So he had filed the return, but he had revised the return. He had revised the return after the time limit for filing these revised returns, right? So he had filed the return in time, but he had revised the returns after the time limit of 139(5). Now, the question before the Supreme Court was whether the CBDT can condone this delay, right? So the Supreme Court observed that the amalgamation scheme which is there, which is sanctioned by the NCLT, the amalgamation scheme is sanctioned by the NCLT, the National Company Law Tribunal, right? Now, in that case, under this NCLT scheme, before the NCLT, the Supreme Court observed that the department had not raised any objection within a period of 30 days. So NCLT gives the notice to the various stakeholders. If they have any objection, they could submit their replies if they object to any particular scheme, right? So any amalgamation or merger happening. So NCLT will issue the notice to the various stakeholders. If they have any objection with respect to that particular amalgamation which is going to be carried out or merger which is going to be carried out, they can reply within 30 days. So department had not raised any objection within that 30 days of service of notice. And after that, the NCLT had sanctioned the scheme. And with effect from that, there was this amalgamation which was given the effect. Right? Because there was no objection received from any stakeholders, including the income tax department. And as a consequence, the amalgamating companies lost their separate identity and character and ceased to exist after receiving the approval from the NCLT. So therefore, the Supreme Court said that these schemes, so this amalgamation scheme which has received the approval from the NCLT, now filing the revised return after the time limit would come into force retrospectively from the appointed date. So there is an appointed date from where the amalgamation will come into force. There is a date of appointment which is given by NCLT that from this date the amalgamation is effective. So therefore, as per the amalgamation scheme, right, the particular appointment date is fixed by the NCLT. Right? So in that case, they would come into force from that particular appointed date. Now, what did the Supreme Court noted in this particular case was that the department was required to receive the return of income, the revised return of income, and assess the income of the assessee, taking into account the schemes of the arrangement and amalgamation which was sanctioned by the NCLT. And in these cases, the provisions of 139(5) would not apply since the revised returns were not filed by the assessee on account of any omission or wrong statement in the original return. So 139(5) is not applicable in this case. The delay was due to the time taken to obtain the sanction from the NCLT for the amalgamation. So it was not possible for the assessee to have filed the revised return before the due date. It was not possible for the assessee to file the return of income before the due date since NCLT passed the orders after the due date. And section 119, which is where the application have to be made to the CBDT, would not be applicable where the assessee had restructured its business and filed the revised return with the prior approval of the NCLT without objection from the department. So are you understanding? So this was a very specific case wherein the assessee had entered into amalgamation scheme which was approved by NCLT giving a particular appointment date from where the amalgamation would come into effect. Now from that time period, the return of income should have been filed. Now, assessee has gone to CBDT for condoning the delay in revising the returns, but CBDT had declined that. So the Supreme Court said, first of all, this is not within the purview of section 119 where the assessee can make an application for condoning the delay or for making an application to file a return of income after the time limit. Because this particular fact of the case indicate that the assessee has gone into amalgamation, which is approved by NCLT, and the NCLT had issued the order to had issued the notices to the various stakeholders, including the income tax department, to submit their objection. Income tax department did not submit any of their objection within the 30-day time period from the date of notice. And therefore, in this case, there is no question of going to the CBDT because the assessee has restructured its business and filed a revised return with the prior approval and the sanction of the NCLT without receiving any objection from the department. Secondly, here section 139(5) for the revised return of income would not be applicable since the returns were not filed due to any error, revised returns were not done due to any error or omission, but because here there was the amalgamation which was to be given to the effect, and the delay was due to the time taken to obtain the sanction from the NCLT. So it was impossible for the assessee to file prior to the sanction received from the NCLT. And therefore, in that case, the assessee's return was considered as appropriate. Clear? So did you understand this case? Yes, Namita, beneficial owner or beneficiary, anyone can file. So ideally, beneficial owner is required. If beneficial owner has filed, then beneficiary is not required to file. Clear? Next particular case is of Delhi High Court in the case of Govind Nagar Sugar Limited, wherein the question before the Delhi High Court was, can the unabsorbed depreciation be allowed to be carried forward in case the return of income is not filed within the due date? So, what does section 80 and section 139(3) says? 139(3) and section 80 requires the filing of return of income for claiming the losses, and the ROI has to be filed within due date. And it applies to carry forward of business loss and not for the carry forward of unabsorbed depreciation. The unabsorbed depreciation becomes the next year's depreciation allowance as per the provisions of section 32(2). And it is allowed irrespective of whether the return is filed within the due date or not. Is that clear? Next particular case is in respect of Odisha Rural Housing Development Corporation by Odisha High Court, where the question before the court was that can an assessee revise the original return of income by filing a revised statement of income and not by filing a revised return. So can assessee revise the original return by filing a statement rather than filing a revised return? So the High Court has said that this is of no value. Revised statement is of no value, right? So assessee can only make a fresh claim only by revising the original return and not by filing any statements. And AO is not going to entertain any such claims by making the revised statements. So only if the assessee has to file something, then it has to be by way of the revised return or the original return. There is no particular claim which is going to be entertained for the purpose of revising the original return. Is that clear? Amalgamated company would have all the incomes of the earlier company, Namita. That is the possible reason, right? Okay. Any doubt other than that? Is that clear? Okay. Certain questions to you now. Quickly tell me. Say, for example, there is a senior citizen of 80 years having total income of 2,85,000. There is a senior citizen of 80 years who is having a total income of 2,85,000. He has claimed a deduction of 1,50,000 under 80C. He has long-term capital gains on the sale of equity shares on which STT is paid of rupees 80,000. Under 112A, it is not taxable since it is lesser than rupees 1 lakh. Whether he is required to file the return of income. Whether he is required to file the return of income. So 2,85,000 is the income. There is a deduction of 1,50,000 There is long-term capital gain under 112A of 80,000. What is your answer in this case? Whether he is required to file the return of income. Very quickly tell me. Yes, Namita, but your reasoning is not correct. No, Shiva, not the correct answer. Yes, Shiva, correct. No, Mukta. Okay, let's try and understand. Yes, Suraya, correct. Correct. Okay. So, in this case, if you see this particular person, as I said, is a senior citizen of 80 years. So, the exemption limit of the 5 lakh will be applicable and not 2 lakh 50, if you remember. It is not even rupees 3 lakh. He is 80 years. So, his total income is 2 lakh 85,000 plus the deduction under ATC 1 lakh 50. So, his total income without considering the chapter 60 deduction is 4 lakh 35, which is less than 5 lakh. He will not be required to file the return of income. However, if he has incurred certain expenditure on, say, electricity over rupees 1 lakh, if he has incurred the foreign travel expense, then in that case he might be, but that is not the information which is given in the question. Is that clear? Is that clear? Clear? What about a trust? Say, for example, there is a trust which has the receipts of, say, rupees 500 lakhs. It has income of rupees 2 lakh 40,000. And it has availed the exemption of, say, rupees 3 lakh 10,000. So if there's a trust which has the receipts of 500 lakhs, it has claimed the exemption of rupees 3 lakh 10,000, and it has now a total income of rupees 2 lakh 40,000. Whether the trust is required to file the return of income? Very quickly. Very quickly tell me. Yes, Shiva, correct. No, Mukta. Okay. So the trust is required to file the return because in the case of the trust, Here, if you see, the trust has the income of rupees 500, income of rupees 2,40,000. If you add the exemption back, 3,10,000, which comes to 5,50,000. So the total income of the trust is exceeding rupees 2,50,000, and therefore the trust is required to file the return of income. You have to consider the total income prior to the deductions, prior to the exemption. Is that clear? Is that clear? Okay, let's move further then. Now, every assessee, there's a requirement for the PAN. There is a requirement for the persons who are mandatorily required to obtain the PAN. 139A requires certain persons to mandatorily obtain the PAN by making an application to the AO. Who is required to obtain the PAN? Every person, if his total income exceeds the basic exemption limit, then that person is required to obtain the PAN by applying on or before 31st May of the assessment year for which the income is going to be assessed. So in case, let me just open this section from module so that you can just, all of you can see. Yes. So under 139A, every person, if his total income exceeds the basic exemption limit, that person is required to make the application for allotment of PAN on or before 31st May of the assessment year. Every person carrying on business where the total sales, turnover or gross receipts exceed rupees 5 lakh in any previous year, before the end of that previous year, the assessee, the person is required to make the application for the PAN. Every person who is required to furnish the return under 139(4)(a). We have discussed about 139(4)(a). What is a 139(4)(a) person? So 139(4)(a) was in case of the charitable trust and institution. So charitable trust and institutions are required to furnish the obtain the PAN if they are required to furnish the return of income. When does a charitable trust is required to furnish the return of income? When their total income before the deduction, before the exemption under section 11 or section 12 exceeds the basic exemption limit. In that case, the charitable trust is required to obtain the PAN, and it has to obtain before the end of financial year. Every person who is a resident who enters into a financial transaction. So every person other than an individual, every resident person other than an individual, for example, company, partnership firm, which enters into a financial transaction of amount exceeding rupees 2,50,000. They have to make an application for the allotment of PAN on or before 31st May. And every partner, director, trustee, founder, karta, or principal officer of such person who is entering into a financial transaction of more than 2,50,000 is also required to obtain the PAN on or before 31st May of the assessment year or the next year following that particular financial year. Clear? So application for obtaining the PAN is mandatory by such person, right? So every person who is mentioned over here has to obtain the PAN, mandatorily. Is that clear? And how they have to apply for PAN? By submitting the proof of identity, address, date of birth. So they have to make an application with respect to obtaining the PAN, right? Also, if say for example, a person has the Aadhaar number, then he can directly on the basis of the Aadhaar number, he can apply for the PAN. So if any person has the Aadhaar number, he can directly intimate the Aadhaar number and he may not require to be submitted any other documents based on the Aadhaar, he can just obtain the PAN. Further, quoting of PAN is mandatory in all the return of income, all the notices, all the submissions you are making, all the correspondence you are doing with the income tax authority, you are required to quote the PAN mandatorily there. In all the income tax challans you are paying, you are required to quote the PAN. So the quoting of the PAN is mandatory with respect to all the challans, all the income tax documents. Further, when you are purchasing any motor vehicle or you are selling any motor vehicle, there also you are mandatorily required to quote the PAN. You are opening any account with a bank or a cooperative bank other than the savings account or the fixed deposit account, you are required to quote the PAN. Say, for example, if you're opening a current account, you are required to quote the PAN there. If you are making the application for credit or debit card, you are required to quote the PAN. If you are opening a demat account, you are required to quote a PAN. If you are making a payment to a hotel or restaurant in cash exceeding rupees 50,000, then you need to give your PAN. If you are making the payment for any travel to foreign currency, or if you are foreign country, or if you are buying foreign currency in cash, if you are making the payment for travel to foreign country in cash over rupees 50,000, or if you are buying foreign currency in cash over rupees 50,000, the PAN will be required from you. If you are purchasing the mutual fund units over rupees 50,000, they will take your PAN. Or if you are purchasing debentures or bonds over rupees 50,000, or if you are purchasing the RBI bonds over rupees 50,000, then the PAN will be required. If you are putting up any deposits with a bank or a post office, then if the cash deposits are more than rupees 50,000 during any one day, the PAN will be required. Or if, say, for example, you are purchasing the bank drafts or pay orders by making the payment in cash over 50,000, PAN will be required. Or if you are opening up a fixed deposit with any banking company, post office, Nidhi, NBFCs for rupees 50,000 or rupees 5 lakh in aggregate during a financial year, one deposit of 50,000 or 5 lakh in aggregate of the financial year, then PAN will be required. Is that clear? If you are making payment of, say, policies, if you are making prepaid payment instruments, or if you're taking any policies, then if the payment is in cash, rupees more than 50,000, the PAN will be required. So if you're taking life insurance policy, more than rupees 50,000, the PAN will be required. If you are purchasing and selling the securities other than shares over rupees 1 lakh, then PAN is going to be taken up mandatorily. If there is sale or purchase of shares which are not listed, unlisted sale and purchase of shares over rupees 1 lakh, then PAN will be required. Sale or purchase of immovable property over rupees 10 lakh, over rupees 10 lakh, or stamp duty value over rupees 10 lakh, then PAN will be required. Sale or purchase of any goods or services over rupees 2 lakhs, there also the PAN will be taken. So where the sale or purchase, if there is any sale or purchase between the dealer and manufacturer also over rupees 2 lakh, they need to quote the PAN. They need to quote the PAN. Is that clear? If any person who does not have any PAN, but he enters into any transaction which I have just now stated, say for example, sale purchase of security, sale purchase of goods over 2 lakh, he shall make a declaration in Form 60, giving the particulars of the transaction, either in the paper form or by generating the electronic verification code. The obtaining the PAN is not mandatory for the non-residents. Obtaining the PAN is not mandatory for the non-resident. In case they have transaction in respect of, so it is mandatory only in cases a non-resident is not required to obtain PAN, but he will be required to obtain PAN in case he is making an application for credit or debit card. So if a non-resident is applying for credit or debit card, in that case, he need to obtain PAN. Or for that matter, if he is making a payment in a hotel or restaurant over rupees 50,000 in cash, or he is making the payment for going to foreign country or foreign currency in cash over rupees 50,000, then he may be required to obtain PAN. Or for that matter, say for example, he is acquiring the bonds, RBI bonds over rupees 50,000, he may be required to quote the PAN. Or in case where he is purchasing the bank draft in cash over rupees 50,000, he will be required to quote PAN. So in selected transaction, he will be required to quote the PAN. Only in selected transaction, he will be required to quote the PAN. Or if, say, for example, there is a sale or purchase over rupees 2 lakhs, even to a non-resident or by a non-resident, they will be required to take the PAN. Clear? Also, when the TDS is going to be deducted or TCS is going to be collected, as I had told you, the PAN is required to be quoted that time. If you do not quote, then there is going to be the applicability of 206AA in case of TDS, right? So the TDS will be at a higher rate. Similar case was there in the case of TCS also. Also, a person who is deducting the tax also has to quote the PAN in all the TDS TCS statement, in all the certificates which are issued for TDS TCS, in all the returns which are filed, right? In all those cases, the PAN has to be there. In case you do not have PAN, but you have Aadhaar number, then in that case, the Aadhaar number can be used instead of PAN also. So if you have linked your PAN and Aadhaar, and if you do not have PAN, but you have the Aadhaar number and you have intimated your Aadhaar number, then the Aadhaar number can be used. So you can use quote your PAN or Aadhaar number in all these transactions if you do not have a PAN. Is that clear? Further, who is not required to obtain the PAN? PAN is not required to be obtained by any non-resident or foreign company who has made the investment in AIF, non-resident or foreign company which has the investment in GDRs, rupee denominated bond, and they have income from capital gain which is exempt under section 47. And these rupee denominated bonds or GDRs are listed on recognized stock exchange and IFSC. So the non-resident who are exempted from filing the return of income are also exempted from obtaining the PAN as well. Are also exempted from obtaining the PAN. Clear? And the non-resident who furnishes the name, email ID, contact number, tax identification number, TRC, then they are not required to give the PAN. They are not required to hold the PAN. Is that clear? Is that clear? Any doubt till now? Mukta, minor can quote the PAN of his parents. Is that clear? For the minor, the PAN can be quoted of parents. Is that clear? Any other question? Okay. Now, if you do not obtain PAN, then there is going to be, of course, the penalty implications. So, if you fail to comply with the provisions of 139A, which is PAN, then there is penalty under section 272B, which is 10,000. Or if you have obtained the PAN, but you have failed to quote PAN or Aadhaar in any documents where it is required to be quoted, or if you have failed to intimate the PAN, then 10,000 for, again, that also the penalty is going to be there. Or if you quote a wrong PAN or Aadhaar, then again 10,000 is the penalty for that. If you fail to ensure that PAN or Aadhaar is duly quoted, then 10,000 is going to be the penalty. 10,000 is going to be penalty for that. So if you do not quote your PAN or if you give a wrong PAN, then 10,000 is going to be the penalty for that. Right? That is under 270A. So you are required to give a correct PAN and you are required to comply with the provisions of 139A. If you fail to do that, then there is going to be penalty of 10,000. There is going to be penalty of 10,000. So if you are not quoting your PAN also in respect of the transactions which we just now discussed, or if you are not disclosing it to the person who is deducting your TDS or who is collecting your TCS, right? So in that case also there's going to be penalty of 10,000. If you are giving a wrong PAN, then also it is going to be 10,000. If, say for example, you are not giving the PAN or Aadhaar number in the documents pertaining to any transactions you are entering. So if, say for example, there is invoice and you are not particularly giving your PAN in that invoice, then in that case also the penalty is going to be 10,000. Is that clear? So you need to quote your PAN or Aadhaar in all the documents for which you have entered into transaction. Otherwise, there will be penalty of rupees 10,000 under 272B. Clear? Even if the person who is obtaining the PAN, so every person who is entering into that transaction, he also has to ensure that the other person has given the PAN. If the other person is also not ensuring that the PAN or Aadhaar is duly quoted in the documents, then there will be rupees 10,000 penalty on that person also who fails to ensure that the PAN or Aadhaar is duly quoted. So it is not just penalty on the person who is not giving, but the person who is obtaining those documents, he also has to ensure that there is that the PAN has been duly quoted on that particular document. If it is not, then in that case, there will be penalty on that person also. Clear? So he has the responsibility to see that the PAN has been quoted. He has also the responsibility to see that the PAN is authenticated. Clear? Is that clear? Clear? Any doubt? Okay. No, Namita, if the PAN is wrong, it is not going to be rectified under 292B. Appointed date, Namita, as I told you, it is the date on which this particular comes into effect, amalgamation. Clear? Also, similarly, like PAN, there is a provision of quoting of Aadhaar number under 139AA. So every person is required to quote the Aadhaar in the return of income as well as in the application form for allotment of PAN. If a person does not have Aadhaar number, he is required to quote, he can quote enrollment ID also of the application form issued to him at the time of enrollment in the application form for allotment of PAN. So if a person is not having the Aadhaar, he can quote the enrollment ID of Aadhaar application form which is issued to him. So when you apply for Aadhaar, the enrollment ID is given to you. You can quote that enrollment ID also at the time of making the application of the PAN or at the time of filing the return of income. And you have to link the PAN with the Aadhaar. So PAN and Aadhaar have to be mandatorily quoted as well as linked while filing the return of income. Now, consequences of failing to intimate the Aadhaar number. If a person fails to intimate the Aadhaar number, then the PAN allotted to that person shall become invalid. What do we mean by that? So if a person who is having the PAN is also required to intimate his Aadhaar, has failed to do so, or if a person has failed to link PAN and Aadhaar, then the PAN of the person will become inoperative. And what do we mean by inoperative? That the person will be deemed that he has not furnished, intimated, or quoted the PAN in accordance with the Act. So where he might have quoted also his PAN, but it will be deemed that he has not quoted because the PAN has become inoperative because of not linking the PAN with the Aadhaar. So he will be liable for the penalty of 10,000 just because he has not linked his Aadhaar with the PAN. And when he intimates his Aadhaar, then only it will become operative. Then only the PAN will become operative. Is that clear? However, obtaining the Aadhaar is not compulsorily for the persons residing in Assam, Jammu Kashmir and Meghalaya, for a non-resident, for a senior citizen over 80 years of age, for a person who is not a citizen of India. Is that clear? Is that clear? Any doubt? Okay. Now next is section 140, which is person authorized to verify the return of income. Now, who is authorized to verify the return of income? In case of individual, the individual himself is authorized. So when you are filing your return of income, at the end of it, you might observe that there is a requirement to verify the return. And you need to quote that I, name this, son or daughter of this, so and so, is verifying the return, right? So in case of individual, he himself is required. If the individual is not present in India, then he can also do it, or he can authorize any person on his behalf who is holding the power of attorney that this person is authorized. Now, power of attorney has to be uploaded on the e-filing portal. Where the individual is not in a capacity to verify the return, he's not mentally he's mentally incapacitated, then his guardian or any other person competent to act on his behalf. Or where the individual is not able to verify the return, then any other person, as I said, who is holding a valid power of attorney can verify the return on his behalf. In case of HUF, the Karta of the HUF has the power to verify the return. Where the Karta is absent, any other adult member. Or where the Karta is not in a mental capacity, then any other adult member of the HUF. In case of the company who is required to verify the return, so if you see when the companies are uploading the return, you have to upload it with the DSC of the director, the managing director. Where the managing director is not able to verify, or where there is no managing director, in that case, any other director of the company. Any other director of the company. Where the company is a non-resident, then any person who holds the power of attorney. Then any person who is holding the power of attorney. Where the company is being wound up, then the liquidator. Or where any person has been appointed as a receiver of any assets, then the liquidator. Where the management of the company has been taken over by the government, then the principal officer of the company. Where the insolvency proceedings are going on, then the insolvency professional is required to verify the return. In the case of firm, it is the managing partner. Where the managing partner is not there, then any other partner of the firm other than the minor partner. Clear? In the case of LLP, it is going to be designated partner. And if the designated partner is not there, then any other partner of the LLP. In case of local authority, it is a principal officer. In case of political party, it is a chief executive officer. In case of association of person, then the member or the principal officer of such AOP. Is that clear? Any doubts till now? Is that clear? Then 140A is the self-assessment tax. We had discussed about self-assessment tax when you were dealing with TDS TCS return, that you are required to pay the self-assessment tax before filing the return of income. If you do not pay self-assessment tax and you file the return of income, will the return be treated as defective? The answer is no. So if you have not paid the self-assessment tax, if you show the tax payable in the return of income and you pay it later, it is not necessary that the return will be treated as defective. So self-assessment tax can be paid, and on that self-assessment tax, your interest under 234A, B, C will be computed. We had discussed about 234B and 234C also. If you remember, there's a shortfall of the advance tax, or the advance tax installments are not paid duly in that time, then in that case, there will be 234B and 234C interest. Is that clear? Any doubts? Okay, there are certain doubts. Let me see. Namita, CA filing ROI is just she's filing the ROI. So there will be no penalty on CA, right? It is on the person who is not quoting the PAN properly. CA is not required to obtain the PAN. Namita, nothing special that these states, about these three states, it is because of the constitutional thing. These three states are not required to obtain the Aadhaar. No, Namit, Harshad, if he has surrendered the one, then he's not required to pay the penalty. Okay. Any other doubt? Okay. So let's proceed further then. Now we will be moving towards the assessment. We are moving towards the assessment now. So we have done about the return of income. Now we are moving towards the assessment. The first kind of assessment, what we are going to discuss now is, before we take a break, is the summary assessment under section 143.1. Summary assessment under section 143.1. Then we will be talking about the regular assessment under section 143. And then we will have reassessment under section 147. And finally, we will have assessment in search cases under section 153A. So first is the summary assessment under 143.1. Now, I had told you about this last time also in the last class. What is summary assessment? Now, 143.1 is just the processing of your return. Now, when you file your return, this particular 143.1. So I'll give you an example. When you sit for your examination, you finish your exam, you give it to the examiner. Sorry, to the supervisor who is present in the class. Now that supervisor will just check that whether you have completed all the questions, whether you have written on the outer side of your paper the questions you have attempted inside the paper. So remember, you have to tick outside the paper that which questions you have attempted. So if you have attempted question 1, you have ticked question 1 outside also. Whether you have done that, whether you have put your roll number also correctly. So he will just check the preliminary things, right? He's not going to assess your answers. That is what even the summary assessment does. So summary assessment under 143.1 is just the major checking of whether you have filled the particulars correctly or not. So what is checked under 143.1 is any arithmetical error, in the return, any incorrect claim which is apparent, from the information in return, disallowance of loss claimed, in a belated return. Disallowance of any expenditure or increase in income not done, or that's right, as indicated in tax audit report but not done in ROI, or disallowance of exemption under section 10AA or chapter 6A deduction if ROI filed or in belated ROI. So these apparent things are checked. Any arithmetical error, any incorrect claim which is apparent, any disallowance of losses in the belated return. So if, say for example, in the belated return you have claimed the losses, that will be disallowed. Any deduction or exemption you have claimed in the belated return which is required to be claimed only as per the ROI filed within due date, that will be disallowed. Any disallowance of expense or income increase which is shown in TAR but which is not taken in ROI, that will be taken off. What is incorrect claim? Incorrect claim means that any item which is inconsistent with another entry in the return. So say for example, if you have shown the sales in P&L say rupees 10 lakh, but in other information you have shown it only rupees 5 lakhs, that is inconsistent. Or if you have shown profits in the P&L say rupees 5 lakh, but in the computation you have shown business profit of only 1 lakh, which is inconsistent, right? Or any claim in respect of which information was required but you have not furnished that information. Any deduction which exceeds the statutory limit. Say for example, if you have claimed deduction of rupees 2 lakh for LIC. So all that apparent claims will be taken into consideration. So if there is any adjustment required, then the intimation will be first sent to the assessee that this is what the adjustments are required, and the assessee has to submit the response within 30 days. Whether it agrees with the adjustment, whether it partially agrees with the adjustment, or whether it disagrees. So you get the intimation under 143.1, right? And if there is any demand raised, then what you do, you go to the income tax portal, you agree, disagree, or partially agree with the response and give your response, right? If no response is received within 30 days, then the processing is carried out by incorporating the adjustments. And based on that, the tax, interest, and fees will be computed. And whatever the demand is there, that demand will be shown as sum payable, or if any refund is due, then refund will be given after adjustment of taxes. Right? So an intimation under 143(1) has to be within, this has to be, the summary assessment has to be within a period of 9 months from the end of the financial year. 9 months from the end of the financial year in which return was made. So say for example, we have the previous year, say 21-22, which is April 21 to March 22. In the previous year, you have paid certain advance tax, you have TDS, TCS, right? Then comes the assessment year, which is going to be 22-23, which is April 22 to March 23. In this year, you file your return of income. Say for this person, it is going to be either 31st July 22 or it can be 31st October 22 or it could be 30th November 22. Right? And if it is a revised return, then at best 31st December 22. Right? Plus you pay your self-assessment tax. Now, the summary assessment which will be carried out, which is under 143(1), this will be before the 9 months from the end of the financial year. So in which financial year the return is made? Financial year in which return is made is 22-23, right? So from March 23, 9 months, right? This is to be by 31st December 23. This has to be by 31st December 23. So 9 months from the financial year in which the return is made, you have to send the intimation. Right? Even in case where there is no tax payable or no refund is due, still intimation will be sent where the loss is declared. Right? So even in the loss is there, in that case also the intimation will be sent. If there is, say for example, no adjustment, if there is no adjustment which is due, then in that case, the acknowledgement of the return only will be deemed to be the intimation. The acknowledgement of the return is deemed to be the intimation. If, say for example, there is already an assessment notice which is issued. There is already an assessment notice which is issued, say before 31st December 23. In that case also, the return has to be mandatorily processed under 143(1). So return has to be, summary assessment has to be mandatorily done even if a notice is issued under 143(2) or 143(2) or 142(1). So this has to be mandatorily done. Clear? So in case where the 143(1) is there, even if the notice has been issued, then still the processing of return has to be there before the issuance of the assessment order. Clear? Further, if say for example any refund becomes due to the assessee under 143(1), if you remember we have discussed that. So if, say for example, there is any refund which becomes due to the assessee under 143(1), then if the assessing officer feels that if the refund is granted to the assessee under 143(1), but then in that case it will adversely affect the recovery of revenue, then with the previous approval of the principal commissioner or commissioner of income tax, the assessing officer can withhold the refund up to the date on which the assessment is made. We have done that. While we were dealing with refund under 237, we have done that. So, if the AO is of opinion that granting of refund may affect recovery of revenue, granting of refund under section 143(1), then with approval of PCIT or CIT, AO may withhold refund. AO may withhold the refund under section 241A. Is that clear? AO may withhold the refund under section 241A. Correct? Also, if you remember, we have done adjustment of income tax refund. So if there is any refund which is due, the AO can set off the refund with any tax or interest which is remaining to be paid for the earlier years. But he can only do that only after giving the intimation to the person that the refund will be set off against the earlier year's tax liability. So, income tax refund can be set off against income tax demand of earlier AYs, but only after intimation to the assessee. Is that clear? Any doubt? Yes, Namita, withholding of refund is done when there is a proceeding pending. Namita, why CA will be required to obtain PAN for filing ROI? Filing his ROI, he will be required, not for the client's ROI. Okay. So let's take a break of 10 minutes and then we get back. Let's take a small break of 10 minutes. Okay. Okay, students. So let's start with it. Now we are proceeding towards the regular assessment. So as I told you, first we have the summary assessment under 143.1 and then we are progressing towards the regular assessment under 143.2. So let's talk about the regular assessment. Now, for the regular assessment, how does the regular assessment starts? So if the AO considers that regular assessment, if the AO is of opinion that assessee has understated the income or has claimed the excessive loss. The assessee has understated the income or has claimed the excessive loss or has underpaid the tax. Then in that case, the AO will issue a notice under section 143.2. This is a show cause notice under 143.2 for the scrutiny assessment. So a scrutiny assessment starts under 143.2 by serving a notice that a detailed scrutiny needs to be carried out. Now this detailed scrutiny, why is carried out? Because under 143.1, we are just checking the arithmetical accuracy or the claims which are apparent. Now if the AO feels that the assessee has understated the income or has claimed the excessive loss or has underpaid the tax, then the notice will be issued under 143.2. That a detailed scrutiny needs to be carried out by asking the information from the assessee, by asking the explanation from the assessee, and therefore the notice under 143.2 begins the regular detailed assessment proceedings. Now, what is the time limit for the notice under section 143.2? The time limit is 3 months from end of the financial year in which ROI is furnished. 3 months from the end of the month, from the end of the financial year in which the ROI is furnished. So here, if you notice, 143.1 was how many months? It is for 9 months from the end of the financial year. Now, if I give 143.2, it has to be within 3 months. 3 months from financial year 22-23, which is by maximum June 23, I should get this notice. And that is why we have a provision that under 143.1D, this was mandatory. So even if notice is issued, say in June maximum, right? You have to mandatorily process the return before the assessment order is made. So 143.1 has to be made before the assessment order. So even if the notice is issued in June, it is not that the summary assessment need not be made. Summary assessment still has to be made. Because why summary assessment has to be made? Because whatever the incorrect claim at least is there and whatever tax arises on that, at least the assessee should be paying off that. Or if not, if any refund is due, that also can be released to the assessee before the assessment is made. But if the refund, if the AO is of the opinion that granting the refund will be adverse to the revenue, then he may withhold the refund till the assessment order is made. So 143(1) is mandatory even if the notice is issued. Correct? Now, where the assessment notice is given under 143(2). Now, as I said, the assessment starts from that point in time. Right? The assessment starts from that point in time. Now, understand one thing very clearly. Now, assessee has to provide the documents to the AO. For that, the assessing officer will see two things. The assessing officer, for asking of any documents, will issue the notice under 142(1). 143(2) is just for starting the assessment proceedings. 142(1) will be notice under 142(1) will be given to produce books of accounts or any documents or any information. But the books of accounts will not be for more than 3 years prior to the previous year. Not before 3 years prior to your previous year. So in scrutiny assessment, the assessing officer cannot ask for more than past 3 years books of accounts. Correct? So if you see, if you have handled assessment at any point in time, you will see that the AO sends a long questionnaire list. Submit your capital account, submit your balance sheet, P&L, your TDS, TCS certificates. That comes under 142(1). Because under that only the AO will ask the information. Or even statement of assets and liability, which is balance sheet. But for asset and liabilities, previous approval of Joint Commissioner is to be required for asking the statement of asset and liabilities. It is quite possible that the assessee has not furnished the return of income only. Quite possible that the assessee has not furnished the return of income. So it is possible that, say for example, that the assessee has earned certain income, but he has not disclosed it by filing the return of income. Then in that case, what needs to be done? Then the AO can issue the notice under section 143(1) by asking the assessee to file the return of income. And that will be also under 142(1). So to furnish the return of income in case the return of income is not filed. In case the return of income is not filed. Now, how will the assessing officer come to know if the return of income is not filed only? How will the assessing officer come to know that the assessee has not filed the return of income and he will come to know that he has income? How will he come to know? So understand one thing, that there is a document called as a statement of financial transaction. Statement of Financial Transaction, or SFT. Statement of Financial Transaction, or SFT. Now, what is the Statement of Financial Transaction, or SFT? Understand one thing. Section 285 BA of the Income Tax Act. Section 285 BA requires certain person to furnish this statement of financial transaction. Requires certain person to furnish this statement of financial transaction. Now, what is this? Who are these certain person who are required to furnish a statement of financial transaction? Say, for example, any bank or a cooperative bank. If they have received any payment in cash for the purchase of bank draft, or if they have received payment in cash more than rupees 10 lakhs for the purchase of the bank drafts, or if they have cash deposit or cash withdrawals more than rupees 50 lakhs from the current account, then they are required to report the person who has done this cash deposit or cash withdrawal more than 50 lakh, or who has purchased the bank draft of more than rupees 10 lakh in cash. If, say, for example, there is a banking company or a cooperative bank or post office which has received cash deposits more than rupees 10 lakhs in the saving bank account, then they are required to report that transaction to the government, to the income tax department. So if they receive cash deposits or withdrawals more than rupees 50 lakh in the current account, or more than rupees 10 lakh in the saving bank account, or more than rupees 10 lakh any fixed deposits made, they are required to report that. Or say, for example, they have received a payment in cash over rupees 1 lakh or over rupees 10 lakh in respect of the credit cards. So if, say, for example, the bank comes to know that the cash withdrawal is happening and a payment is made by a person of 1 lakh or more in cash, or 10 lakh or more payment to the credit card company, then the credit card company will be reporting the PAN to the income tax department of that person. Or a person, if a person is purchasing, say, 10 lakh rupees bonds or debentures, that company issuing the bond or debenture will report the PAN of that person. If a person is purchasing the shares of 10 lakh or more, either in IPO or through the market, then the company issuing shares will be reporting the PAN. Or if there is, say, for example, buyback of shares more than 10 lakh, or for example, a mutual fund company is receiving 10 lakh or more for the units purchased, or if, say, for example, a bank or the authorized dealer is receiving the foreign exchange, is receiving any foreign exchange, right, over rupees 10 lakh. Or if any person is purchasing foreign exchange over rupees 10 lakh, if there is sale purchase of immovable property, then the registrar of the property where the stamp duty is paid, if the property value is more than 30 lakhs, the PAN will get reported. Any person receiving in cash any person who is receiving the payment in cash over rupees 2 lakh for sale of any goods or services, any person, then that person who is required to carry out the audit is required to report this transaction to the income tax department. So all these transactions get reported to the income tax department. Now, if these transactions are reported to the income tax department, these are reported in Form 61A by 31st May. By 31st May, then in that case, by 31st May of the following financial year, then in that case, the income tax department is receiving the information that yes, this person has certain income because he has carried out a big transaction. And if he has carried out a big transaction and he has not filed the return of income, means there's something suspicious. So income tax department will come to know. Yes, Harshad, AIS is there. AIS, how do they get the information in AIS? They get the information in AIS through the SFT only. So when I report in SFT that this person has withdrawn the cash, this person has done this property transaction, that will get automatically reflected to my AIS. And if I have not filed the return of income, then the AO can ask me to file the return of income under section 142(1). Under section 142(1). So therefore, I can file my return of income also under section 142(1). Now, if I file my return under section 142(1), then that also will be a belated return. That also will be a belated return, isn't it? Because I had not filed the return of income under the due date. I had not filed my return of income within the due date of 139(1). Correct? So this is also a belated return only, but this is in response to the 142(1) notice. But if, say, for example, I was not required to file only the belated return. Say, for example, return. If I was not required to file the return only, then if I file before the completion of the assessment or within the time limit given under 142(1), then it may not be a belated return. So if I am required to file in the 139(1) and I have not filed it, then it is a belated return only. But if I was not required to file the return only, say for example, I did not have any income and the AO has just asked me to do it, then even in the 142(1), it will be a belated return. Is that clear? So under 142, the AO can ask me to furnish the return of income. That is one thing. Or he can ask me to give or furnish any information. Clear? Now 142(1), what is the time limit? The Act does not provide any time limit for 142(1). So 142(1) can be issued at any time before the completion of the assessment. So before completing the assessment, the AO can issue any number of 142(1) for asking me the information. Is that clear? Now, say for example, the AO is now feeling that the accounts of the assessee are very complex, or there is this assessee which has like a huge turnover. It's a listed company and there is like huge volume of the accounts. Or he feels that this assessee's accounts are doubtful. Or there is like a very new kind of business which the assessee is doing, which is out of the AO's knowledge, that how he could carry out or process this information or verify this information. Then he can request for an audit under section 142. So if at the stage of the assessment proceeding, the AO feels that there are the complex accounts of the assessee, or due to the volume of books of accounts, or considering he has a doubt about the correctness of the books of accounts, or there are multiple transactions are there, or for that matter, specialized nature of business. In that case, with the approval of the PCIT or CIT, with the approval of PCCIT or CCIT or PCIT or CIT, he can direct the assessee to get his accounts audited and furnish the report. So considering the nature and complexity of accounts, specialized nature, volume of accounts, correctness of the account, doubts on that, or multiple transactions, he can direct the assessee to get his accounts audited by a CA. Now, will the assessee will be appointing that CA? Answer is no. The CA will be appointed by the Principal Chief Commissioner, PCCIT, CIT, CCIT or PCIT. And the auditor will be required to furnish the report to them. So the CA will be appointed by the Income Tax Department only and not by the assessee. Is that clear? Now, before the audit can be carried out, before the direction is given, the assessee will be given an opportunity of being heard before issuing the directions for special audit. So, opportunity of being heard to be provided to the assessee. It is possible that the assessee's books of accounts are already audited under any other law. In that case also, the special audit may be directed. What is the time limit for this? So AO will issue the order to the CA to carry out the audit within the prescribed time, within the time he feels so. But the time limit should not exceed time limit or even the extended time limit if the AO is extending on application of assessee, 180 days. Should not exceed 180 days from the date of order issuing the directions. Here. Now, if the CA has given certain evidence in the audit, then the opportunity of being heard should be given to the assessee on the basis of the material gathered under the audit, which will be used for the purpose of assessment. Is that clear? If in case the assessee is not getting the audit done, then in that case, fails to get audit done, then it will be assessment under section 144, which is called as best judgment assessment. What is best judgment assessment? That if the assessee is not cooperating, then the AO can assess the income to the best of his judgment. However, if the CA fails to get the books of accounts audited, if the CA is not auditing, assessee is ready to cooperate, then there will not be assessment under 144. Is that clear? If the CA refused to do the audit, even if the assessee was cooperating, then it will not be under 144. If, say, for example, there are certain properties of the assessee or certain investments of the assessee which are unexplained, and now the value of that is not very clear. So for the purpose of determining the fair market value of the asset, property or investment, because if you know, these unexplained investments, assets or property get added as income under section 68, 69A of the assessee, right? Then for the purpose of determining the fair market value, the AO can make a reference to the valuation officer. This is under section 142A. AO can refer to the valuation officer. Is that clear? Then the valuation officer will estimate the value of asset, property, or investment. And if the assessee again does not cooperate, then it will be the best judgment assessment. What is the time limit for submission of the valuation report? Time limit is 6 months from end of month in which reference was made. Is that clear? If assessee doesn't cooperate, it will be 144 assessment, best judgment. Clear? Is that clear? Now, understand one thing. All this information which is done, which is asked from the assessee, all this valuation which is going to be requested, and the assessment itself which is going to be made will be under section 144B. Faceless assessment. Now, all this assessment is going to be in a faceless manner. So you don't know who your AO is going to be. Now, what is this faceless assessment? How will this assessment happen? Now, when I said that this 143.2 notice will be issued, that the assessment is starting, this notice will be issued by a National Faceless Assessment Center, NFAC, National Faceless Assessment Center. Now, what is this National Faceless Assessment Center? Let's try and understand. National Faceless Assessment Center is the unit which is set up in a centralized manner, which will make the assessment. Below this National Faceless Assessment Center, there will be regional centers. There will be regional faceless assessment center. And below that, there will be the assessment units, which will be actually making the assessment. But all the communication by the assessee and by the income tax department to the assessee will be through this National Faceless Assessment Center. So understand one thing very carefully. So this notice, which is going to be issued under 143.2, is going to be by National Faceless Assessment Center. Is that clear? Now, when the notice is issued to the assessee under 143.2, the assessee is required to submit the response to this within 15 days. Within 15 days from the date of receipt of notice. Now, in this case, even 142.1 or all of these will be through this particular faceless centers only. Is that clear? Is that clear? So where the AO wants to ask further information under 142.1 or AO wants assessee to require to file the return under 142.1, that will be through this NFAC only. Now once the assessee has submitted the response to the 143.2, so there is going to be notice under 143.1 and assessee will submit the response. Then this NFAC will then assign the case to an assessment unit, which I will call it as AU, to the assessment unit under any one regional faceless assessment center. Now, regional faceless assessment center are nothing but assessment centers set up in different regions, and they have the assessing officers sitting there. Now, assessment unit will be taking care of the assessment. So, faceless assessment center is nothing but National Faceless Assessment Center, NFAC, is the middle point between the assessing officer and the assessee. NFAC is just a centralized point, right? Now, assessment will be done by the AU only, where the assessing officers are situated. Now, as I said, at this stage, if the AO feels at the assessment unit, now this will be happening at the assessment unit, where the AO would feel that the information is required from the assessee, books of accounts are required from the assessee, then in that case, the AU may make a request to the NFAC. So NFAC will assign the case, AU will ask the NFAC if it feels any further information is required from the assessee. Is that clear? Now, the NFAC will then in that case will issue the response to the, will issue the order to the, one second. Just give me a moment. I think there's some issue here. Okay. So NFAC will then ask the assessee. NFAC will then ask the assessee to give the information, which will be under 142.1, right? So NFAC will issue the notice to the assessee for asking them to give the information, documents or evidence required by the assessment unit. Assessee will again submit the response to the NFAC. Assessee will submit the response to NFAC, and NFAC will then forward that to the assessment unit. NFAC will then forward it to the assessment unit. So are you understanding? So what is happening out here is that NFAC is going to be a central point between the assessee and the AUs. So NFSE will first issue the notice under section 143(2). Assessee will file the response within 15 days. Right? NFSE will then allocate the assessment to the AO. AU will request for information from NFSE, which is required from assessee. NFSE will then ask the assessee to give the information by issuing notice under section 142(1). Assessee will provide the information, right? And NFSE will then give this information to the AU. So NFSE is acting as a centralized point between assessee and the AU. Is that clear? Now, it is possible that the AU is feeling that this information requires certain verification. This information requires some verification, and the AU is feeling that there is help required from another assessing officer also. So what they have done is, under this particular scheme, they have set up a verification unit also, which inquires, which carries out the further inquiry, which do the cross verification, which do the examination, which issues the summons for inquiring. So therefore, the AU may request the NFSE, that the inquiry or verification to be assigned to the verification unit. So AU may request NFSE for the purpose of verification or further inquiry by some other assessment unit. Then NFSE will give it to a verification unit. Now, what is the job of verification unit? Verification unit will verify, cross-examine, will issue the summons, will do the further verification. That is the role of the verification unit. And NFSE, whatever information it will receive from the verification unit, will give it to the, again, assessment unit. Also, there is possibility that there are certain technical points which the AO would like to ask to another AO. So therefore, there is also a technical unit set up under this scheme. So if the AU feels that there is a need for technical information, there is a need for asking a technical information, or there is a need that some technical assistance is required on some legal, accounting, forensic, or say, for example, the valuation needs to be carried out. There is some transfer pricing reference to be made to the transfer pricing officer. So the AO may not be competent to do everything. There are specialized transfer pricing officers also in the assessment centers, right? So the reference may be made to them, or the reference is required to be made to the valuation officer. Then in that case, the AU may request to the NFSE to tell to the TU that the technical assistance is required. Then TU will supply the information to NFSE, and NFSE will again give it to the AU. Is that clear? Now, once the AU has all the information, Once the AU has all the information, then in that case, the AU will carry out the assessment. Now, as I told you that if say for example, here the assessee is not giving the information under 142.1. If the assessee is not giving the information under 142.1 or he is not complying with the notice issued under 142.1 to file the return of income, right? Or he has not filed the return of income under 139.4 or under 139.1, or he is not complying with 142A, the audit or the valuation, right? Then what AO will do is AO will carry out the best judgment assessment. So if the assessee does not cooperate under section 144, under section 142A, then in that case, or under best judgment assessment under section 144, right? If assessee fails to furnish ITR under section 139.1, 139.3 or 139.4, right? Or 139.5, or assessee fails to furnish ROI in response to notice under section 142.1, right? Or assessee does not comply with 142.1 requirements what the AO has asked for. Assessee fails to comply with special audit, right? Assessee fails to comply with that as well. Or for that matter, the assessee is failing to comply with the valuation also, reference made to the valuation officer, right? In all those cases, what can be done is the in that case, what can be done is the best judgment assessment will be carried out. Or for that matter, the assessee fails to comply even with 143.2 notice. Then there will be the best judgment assessment under 144. But assessee will be given an opportunity of being heard. Is that clear? Now, if the best judgment assessment is being carried out, so where the assessee fails to comply with 143.2, with 142.1, or for the special audit, the NFSC will serve a notice under 144, giving the assessee an opportunity of being heard by issuing a show cause notice as to why the best judgment assessment should not be done. So even that will be done by NFAC by issuing a show cause notice that why we should not do a best judgment assessment. And the assessee will file a response to this. Is that clear? The assessee has to file the response to this. And where the assessee does not file the response to this, If no response, then the NFSC will intimate to AU. If no response is filed, the NFSC will intimate to AU to carry out the assessment as per 144. Is that clear? So, in all these cases where, say for example, NFSC issues 143 notice or 142 notice, assessee has to file the response within 15 days. If the assessee fails to do that, then in that case, NFSC will issue show cause notice under section 144. If the assessee still fails to give the reply, then NFSC will ask the AU to do the best judgment assessment under section 144. Is that clear? Now, AU will take all the material into account and will prepare, the AU will prepare a draft assessment order. The AU will prepare a draft assessment order. Now, this was the first stage wherein the notice were involved and information was being received. In the second stage, when the assessment orders are being issued, so AU will issue the draft assessment order. Is that clear? Plus, it will start if the penalty proceedings are to be implemented. So if there is any penalty to be levied, that also will be given. Now, NFSC, what it will do, it has two options. One option it has to finalize the assessment. NFSC can finalize the assessment in case there is no variation which is prejudicial to the interest of the assessee. And what NFSC will do is, it will serve on the assessee the copy of order and any penalty proceedings which are initiated along with demand notice. Demand notice is under what section? Under 156, right? So it will finalize the assessment if no variation prejudicial to assessee. In case there is any variation, if there is any variation which is prejudicial to assessee, then in that case, it will give a show cause notice to the assessee. It will give a show cause notice to the assessee as to why this particular addition should not be made. Or the third option which it has is, it can assign the order to a review unit. So this is the first option it has, this is the second option, and this is the third option. It can assign the order to the review unit. If the NFSC feels that the assessment order is dicey, maybe the assessing officer has not properly carried out the assessment, it can give the draft assessment order to the review unit. What do the review unit do? Review unit will verify all the material and evidence review unit will check everything in the order. What are the facts? What is that? Whether the AO has correctly applied the law, whether the additions or disallowances have been made correctly, whether the judicial decisions have been taken into consideration, the arithmetical correctness of the additions proposed. So review unit will verify everything. Now, based on the review units, review unit can either say that the assessment order is proper and review unit will intimate this to NFSC, or review unit may ask NFSC that, okay, these are the changes which are suggested. So review unit can either accept or suggest changes in the order. Now NFSC, if it has received the acceptance of the review unit, then in that case, NFSC can then directly finalize the assessment in case there is no variation, or it can just issue a show cause notice to the assessee if there is a variation which is prejudicial to the interest of the assessee. Is that clear? But if the review unit has suggested the changes, then what will NFSC do? If the review unit has suggested the changes to the NFSC, then NFSC will give this assessment order to other AU, not to this AU back, but to the other AU, because it thinks that this AU has not performed well. Is that clear? It will assign the case to other assessment unit. And this assessment unit will then, other AU will then send the final draft assessment order. It will send the final draft assessment order. Now again, when the NFSC receives the final draft assessment order, it has the two options. Either it can finalize the assessment if there is no variation prejudicial to the interest of the assessee, or it can issue the show cause notice if there is a variation which is prejudicial to the interest of the assessee. So what is happening here is that NFSC, when it is receiving a draft assessment order from AU, it can send to the review unit for the purpose of checking the correctness of the order. Review unit, if it accepts, then NFSC can just finalize the assessment or suggest the changes, or it can suggest the changes. When it is suggesting the changes, then the NFSC will give it to the other AU, other than the one which has prepared. And this other AU, based on the recommendations of the review unit, can finalize a draft assessment order and send it back to NFSC, which will then again either finalize the assessment or will give a show cause notice to the assessee. Now, when it is giving the show cause notice to the assessee has to furnish the response to that show cause notice. Right? So NFSC will then, what it will do, if the assessee is filing the response to the show cause notice, what NFSC will do is it will send the response received. It will send the response received to this assessment unit. It will send the response received to this assessment unit. And now what it will do is, this assessment unit will then again make an order. This assessment unit will again make an order which will be called as revised draft assessment order. revised draft assessment order. Is that clear? So this assessment unit, based on the responses received from the assessee, can issue a revised draft assessment order. Is that clear? And again, it will send to NFSC. Now again, NFSC has the option, in case there is no variation which are prejudicial to the interest of the assessee in comparison with the earlier draft assessment order or the final draft assessment order, then in that case, it can finalize the assessment, which was again the same case here. Correct? And in case it is a case of transfer pricing, if it is a transfer pricing case, then what can the NFSC do? It can pass the draft assessment order. So for the transfer pricing cases, we do not have the final assessment order directly. We have the draft assessment orders. If there is any addition made in the transfer pricing cases, then it's a draft assessment order. And what it will do, it will send this revised final order to the assessee. It will then give the draft order in TP cases or final order to the assessee. Is that clear? If there are variations which are prejudicial to the interest of the assessee in comparison with the revised order which is now received and the earlier order which was received, then again a show cause notice will be issued to the assessee regarding that addition which is made, new addition which is going to be made, and again the same thing, same procedure will apply. Again the same procedure will get applied. And what is that procedure? That the assessee has to submit the show cause notice. It will again go to, the response will go to the again assessment unit, and the assessment unit will then make the final assessment order and give it to NFSC. NFSC will then finalize it. Is that clear? If, say, for example, the assessee is not replying to this show cause notice, if the assessee fails to reply to this show cause notice, then in that case, the NFSC will finalize the assessment. Then the NFSC will finalize the assessment. If the assessee is not replying to show cause notice, then the NFSC will finalize the assessment and send the assessment order to the assessee. In case it's a TP case, then the NFSC will send the draft assessment order. Is that clear? In case of the draft assessment order, the assessee has two options. Either he can go to DRP, Dispute Resolution Panel. In transfer pricing cases, it is the draft assessment order. So for the draft assessment order, if there is any addition which is made, you can go directly to DRP instead of going to CIT appeal. So you can go within 30 days to the DRP, or he can just give his acceptance within the 30 days. So if there is no objection received from the assessee within 30 days, then the NFSC will finalize the order. In case the assessee goes to DRP, then based on the directions of the DRP, the NFSC will give the directions to the assessment unit. Assessment unit will prepare the final order. The assessment unit will finalize the order as per the directions given of the DRP. It will again issue the draft assessment order to NFSC. NFSC will then finalize the assessment within the 1 month from the directions of the DRP. Is that clear? So this is how the assessment is made under the faceless assessment scheme. Any doubt do you have till now? Yes, AU has assessing officers only, Namita. Namita, yes, if the assessee does not submit response to 142, then NFSC will assign to AU. Namita, as I said, if CA withdraws from audit, then best judgment assessment will not be made. Yes, Namita, if he does not have income, then 142.1 is the belated return. Okay. Now, all this is faceless, right? All the information will be exchanged only through your income tax portal and through emails. So the notices copy, orders of copy, order copy, all that will be given to you through your account on the income tax portal and on your email address. And on your email address, right? So all this is going to be electronic. You have to furnish all these replies also electronically through your income tax portal, right? There is no going to be any personal appearance. But assessee in specific cases where, for example, there is an addition in the draft assessment order or in the revised draft assessment order or final draft assessment order, then if the opportunity is provided to the assessee by issuing a show cause notice, then in that case, the assessee may request for a personal hearing to make the oral submissions. Assessee can request for personal hearing through the oral submissions. And the CCIT or DGIT, which are there in any regional faceless assessment center, may approve the request for personal hearing if they are of the opinion that there are circumstances in which case the personal hearing can be approved. But the personal hearing will be granted only through video conferencing only. So it will not be that you have to go and explain it to the income tax officer. It will be through video conferencing. It will be only through video conferencing. Is that clear? So this is how the assessment has to be made under the faceless assessment center. NFSC is going to be responsible as a central point between the assessing officer and between the assessee. Is that clear? Any questions so far? Any questions, any doubts? Okay. Last one thing. Now, as I told you that certain research associations or institutions which are claiming exemption under 1023C, they need to file their return of income if their income exceeds basic exemption limit without considering this exemption. So in these cases, the AO cannot just make an assessment. The Act requires AO to make the assessment only by intimating the central government, because central government has given the approval to these funds, institutions or trust, universities for claiming the exemption. So the AO cannot make an assessment denying the exemption under Section 10 without intimating the central government or the prescribed authority that these institutions are not fulfilling the conditions of Section 10, and therefore the approval granted to these institutions should be withdrawn. So the AO cannot make an assessment without intimating the central government or the prescribed authority of the contravention of the Section 10 provisions, and the AO cannot reject the exemption granted to these institutions till the central government withdraws their approval. Till the central government or the prescribed authority withdraws the approval. And therefore, the AO will get an extended time till the approval is withdrawn. Till the approval is withdrawn for these institutions. Because the approval is given to them by the central government or prescribed authority, so the AO is not empowered to make the assessment AO is not empowered to make the assessment by just denying the exemption under Section 1023C without intimating to the central government that these particular institutions are not following the conditions of 1023C, and only when the central government will withdraw their approval, only then the AO can make the assessment denying exemption under 1023C. Is that clear? Also, if you know that the trust or an institution will not remain charitable if its commercial receipts are exceeding 20% of the total receipt. So, the Act has said it that in case of the charitable trust or institution, if they have the commercial receipts more than 20% of the total receipts, they will not remain commercial. But just temporary excess receipts in 1 year, temporary excess receipts in just 1 year will not lead to the cancellation of the registration of the trust or withdrawal of the approval given to these trust or institutions which are carrying out the charitable objective. So 1 year excess may not directly lead to the violation of this condition and will not lead to the cancellation of registration. But the trust or institution will not get the exemption under 1023C if its commercial activities exceed 20%, if the receipts from the commercial activities exceed 20% of the total receipts. So registration will not be withdrawn immediately if the commercial receipts are more than 20%. But the trust will not get exemption at least in that year under 1023C. So in these cases where the commercial receipts exceed 20% of total receipts, in that particular year, the AO will not give the exemption under section 1023C while making the assessment, even if the registration is not withdrawn or even if the approval is not withdrawn. Because as I said, if the commercial receipts exceed of a charitable trust by 20%, in 1 year itself, the trust's registration will not be withdrawn. But the AO will not give the exemption because the exemption is not allowed if the commercial receipts exceed. So even if the registration is not withdrawn, still the AO will not give the exemption under section 2023C. In all other cases where it's not a case of charitable trust or where it is not the case that there is the violation of this condition of commercial receipts exceeding 20%, in that cases the AO cannot deny the exemption under section 10 till the time the registration or the approval is withdrawn by the authorities. Clear? AO has the power to send the proposal to the government recommending withdrawal of the approval if these trust institutions have not followed the guidelines, or if not trust and institution have not been following the conditions based on which these exemptions are given. Clear? Any doubt? Any doubts you have before we close the session? If you want to ask any doubts. Okay. So see, in the next class, what we will be doing is we will be starting with, so we have completed faceless centers and faceless assessment, right? In the next class, we will be starting with the assessment in the case where the GAR is there. Then we will be doing 147. We will be also talking about DRP, what we have discussed today. We will be starting with 147, reassessment, and finally we will be dealing with the search cases. Assessment in case of search. So search and survey, we have already done it in the last class, but what we will be dealing with is the time limits in the case of the search. And the remaining provisions so far we will discuss. So if you do not have any doubts, we can just end the session here and we can connect in the next class. Okay, so if there are no further doubts, let's stop it here and see you in the next class. Thank you so much.